Hi everyone, welcome back to my YouTube channel. This is Gisrael H. Raz, and in this video, we will continue our discussion about allowable deductions, particularly on taxes, as an itemized deduction against our gross income. If you're ready, let's start! So what is a tax? A tax is a demand of the sovereign imposed on people, property, and right. It is the amount we pay to the government, and I'm pretty sure that you already have an idea of what a tax is. Taxes paid may also be deducted from our gross income subject to the existing provisions of the tax code. And we have these rules, general rules. Taxes paid or incurred within the taxable year in connection to the taxpayer's profession, trade, or business shall be allowed for deductions. So any taxes paid by a taxpayer which are in relation to his business or trade or practice of professions can be deducted from his gross income, except the following taxes. So these taxes are non-deductible from the gross income of any taxpayers. Number one, income tax. An income tax cannot be deducted from the gross income. So what are these income taxes? The final income tax. We have already discussed what is a final income tax in our previous video. Also, the creditable withholding taxes. Those are also income taxes. We have also discussed the capital gains taxes. These capital gains taxes are also income taxes. So these taxes cannot be deducted from the gross income of any taxpayer. So next we have income taxes imposed and paid to authority of any foreign country. They are claimed as tax credits subject to limitations. So if a taxpayer is a resident citizen or a domestic corporation, remember that resident citizens and domestic corporations are taxable for their income sources from within the Philippines and outside the Philippines. Their income taxes paid abroad can only be claimed as tax credit. So later we will have a discussion, an illustration of what a tax credit is. So again, those income taxes paid in foreign country by a resident citizen or a domestic corporations, they can be deducted as tax credits. However, when the taxpayer does not signify the same as tax credits, deduction for taxes paid to foreign country shall be allowed. So in this contrasting statement, it is said that when a resident citizen or domestic corporations who are subject to income taxes for their incomes within the Philippines and outside the Philippines, and when these resident citizens and domestic corporations paid income taxes to foreign countries, general rule, these payment to foreign countries are considered as tax credits. They cannot be deducted from the gross income as taxes. However, in the contrasting second statement, it is said that when the taxpayer does not signify the same as tax credits, meaning when the taxpayer, the resident citizen, or the domestic corporation failed to claim these taxes paid abroad as tax credits, they can deduct these taxes paid abroad as a deduction from their gross income. Okay, so meaning to say there are two choices for resident citizens and domestic corporations. Number one, they can claim those taxes paid abroad as credit against income taxes due in the Philippines. Or number two, they can claim these taxes paid abroad as a deduction from their gross income. You might be wondering, how about the non-resident citizen? How about the resident alien? How about the foreign corporations or the non-resident aliens? Again, we have only two taxpayers who are subject to global taxation, and these are the resident citizen and the domestic corporation. All other taxpayers, the non-resident citizens, the resident aliens, they are only subject to income tax for their incomes earned in the Philippines. Therefore, any taxes paid abroad cannot be deducted from their gross income here in the Philippines. Also, we have another exemption, estate and donors tax. These taxes are non-deductible. So what is an estate tax? Estate tax is a tax imposed on the properties or assets or estates of a decedent, someone who died. Okay? When we die and we have a lot of wealth, we have properties, we have estates, before our heirs, our children or spouse could inherit these properties or estates, a tax would be first imposed, and that is 6%. How about donors tax? Donors tax is a tax on gifts. When we give something to someone for free, we are actually subject to 6% donors tax. And finally, we have here special assessments. These are taxes assessed against local benefits of a kind tending to increase the value of the property assessed. So special assessments are actually impositions or assessment on certain properties. And these special assessments are also cannot be deducted from our gross income as taxes. Okay? So let's have an illustration. Taxes paid by a corporation within a year were the following: normal income tax, 500,000; improperly accumulated profit tax, which is 300,000; capital gain tax, 740,000 pesos; and final tax, which is 50,000 pesos. Community tax. This is a poll tax. So 10,500. We also have here value added tax, 89,000 pesos. We also have local taxes and licenses, which is 10,000 pesos, and interest for late payment of national and local taxes, 40,000 pesos. And finally, we have surcharges for late payment of national and local taxes, 60,000 pesos. So we are asked, how much is the deduction for taxes? As we know, income taxes are non-deductible. So normal income tax, this is non-deductible. Improperly accumulated profit tax, this is also non-deductible. Capital gain tax, non-deductible. Final income tax, non-deductible. Community tax, this is deductible. Value added tax, this cannot be deducted because essentially value added taxes do not form in our income. Okay? Local taxes, still deductible. Interest for late payment, this could be deducted but under interest, and we are asked for taxes. So therefore, this cannot be deducted under taxes. This can, however, be deducted under interest. Surcharges for late payment, this is a penalty. A penalty is non-deductible. Always non-deductible. Therefore, among the 10 items that we have, we can only claim expense from community taxes paid and from local taxes and licenses. Therefore, only 20,500. That is community tax, which is 10,500, and local taxes and licenses, 10,000. So the income tax, improperly accumulated profit tax, the capital gains tax, and final tax are all income taxes. The value-added tax cannot be deducted from gross income because they are treated differently against the output VAT. In our advanced lecture in the value-added taxation, we will justify why value-added tax are not deducted from the gross income. Always remember, VAT cannot be deducted from the gross income unless you are a non-VAT registered. The interest for late payment may be deducted but as interest, not as taxes. And finally, the surcharges cannot be deducted at all because such penalty arise from non-compliance of the law and thus must not be tolerated. The law will not allow penalties as deductions from our gross income because the law does not tolerate late payments. Okay? So we have here limitations on deductions. In the case of non-resident alien individual engaged in trade or business in the Philippines and a resident foreign corporation, the deductions for taxes shall be allowed only if and only if to the extent that they are connected with the income from sources within the Philippines. So again, always remember, taxes, like any other expenses and other itemized deductions, can only be deducted from the gross income if these are necessary, ordinary, and substantiated, meaning this must be connected with the taxpayer's business, trade, or practice of profession. If the tax is paid by the non-resident alien engaged in business or resident foreign corporation is not related or connected to their business, therefore these taxes cannot be deducted from their gross income. Okay? We have mentioned that for resident citizens and domestic corporations, they are allowed to claim tax credits for their income taxes paid abroad. We have also mentioned that resident citizens and domestic corporations are taxed on their incomes from within the Philippines and outside the Philippines. Hence, they can deduct income taxes paid to outside of the Philippines. So at this point, we will talk about how to claim tax credit for resident citizens and domestic corporations who have incomes from outside of the Philippines. Also, we have mentioned that if the taxpayer has taxes paid abroad, these taxes can be charged against his income tax due in the Philippines. Otherwise, he can claim such taxes as a deduction from his gross income. It is said that if the taxpayer signifies in his return his desire to credit the taxes paid in foreign countries, the income tax due thereon shall be credited with: first, for the citizen and domestic corporation, the amount of income taxes paid and incurred during the taxable year to any foreign country. As I have said, only resident citizen and domestic corporation may claim tax credits as they are taxed globally, meaning regardless of their source of income. Also, for partnerships and estates, for individual who is a partner of a general professional partnership or a beneficiary of an estate or trust, his proportionate share of such taxes of the general professional partnership or the estate or trust paid or incurred during the taxable year to a foreign country, if his distributive share of the income of such partnership or trust is reported for taxation purposes. As I have said earlier, it is only the resident citizen and domestic corporation and domestic partnership and even the partners who are resident citizens can claim tax credit for income taxes paid abroad. And a partner may claim a proportionate share of tax credit paid to a foreign country only if he is a resident citizen. Always remember that. On the other hand, an alien individual and foreign corporation shall not be allowed the credits against the tax for the taxes of foreign countries allowed for tax credits because they are only taxed for their income in the Philippines without regard to their income outside the Philippines. So let us illustrate this example so you will imagine what is a tax credit really look like. Okay? A domestic company has the following income and expenses for the year 2018. So we have here, this domestic company have income sources from the Philippines, from Canada, and from New Zealand. So we have sales, 4 million in the Philippines, 2 million in Canada, and 3 million in New Zealand. We also have here cost of sales, which is 2.3 million in the Philippines, 1 million in Canada, and 1.4 million in New Zealand. We also have expenses, 700,000 pesos in the Philippines, 600,000 pesos in Canada, and 1 million pesos in New Zealand. And the income taxes paid to Canada and New Zealand are 200,000 pesos and 150,000 pesos. So in this case, the domestic corporation has business in the Philippines at the same time in Canada and New Zealand. And since this domestic company is operating in Canada and New Zealand, of course, it will pay taxes to Canada and New Zealand, right? So it is said that this domestic corporation paid 200,000 from its income earned in Canada. Also, it paid 150,000 pesos to the government of New Zealand for its business in New Zealand. In short, this domestic corporation already paid the tax in Canada and New Zealand for its business in Canada and New Zealand. However, since the company is domestic, even though these incomes, these sales and expenses have already been subjected to tax, even though the taxpayer already paid taxes to Canada and New Zealand, still, it has to report these incomes and expenses to the incomes in the Philippines. Why? Because the law required to report these income and expenses earned and incurred in Canada and New Zealand. Therefore, we will have a cumulative computation for this problem. So assuming the corporate tax rate is 30% in the Philippines, how much is the tax due and payable? But before that, let us first answer this question. Is the taxpayer allowed for tax credit? What will be your answer? Yes. The taxpayer is a domestic corporation subject to the Philippine income taxes for all of its incomes from sources within and outside the Philippines. Therefore, since it is subject to income taxes for all of its incomes, it can also claim taxes paid outside of the Philippines. So the first step in resolving this problem is to compute the income tax due. So we have here from sources in the Philippines, Canada, and New Zealand, we have sales, we have cost of sales, and therefore we would have gross income. In the Philippines, it is 1.7. In Canada, we have 1 million, and in New Zealand, we have 1.6 million. And we would also deduct the expenses, so we will have a net taxable income of 1 million in the Philippines, 400,000 in Canada, and 600,000 in New Zealand. So we will add these three together to get the aggregate taxable income. So the consolidated income within and outside is 2 million. That is 1 million plus 400,000 plus 600,000 equals 2 million. And the tax rate, as we know, as given in the problem, it is said the tax rate is 30%. Therefore, the income tax due is 600,000. Okay? So this 600,000 is supposedly the amount to be paid by this corporation to the Bureau of Internal Revenue. This is the amount that should have been paid entirely by this domestic corporation. However, remember that this corporation already paid taxes in Canada and New Zealand. We will use those amounts, those figures, to reduce this income tax due. We will claim for tax credit. So how do we claim for tax credit? There are two approaches in claiming for tax credit. The first step is to compute the tax credit under limit 1 or the limit per country. Again, this is the first limit, the first step, the per country limit. So, we will have here from Canada. Remember that the net income in Canada is 400,000 pesos and the entire net taxable income is 2 million. We will allocate the 600,000 tax due based on the proportion of the net taxable income from Canada. That is 400,000 pesos divided by 2 million. Therefore, the limit is 120,000 pesos. Okay? This is the limit based on the proportion of the net taxable income to the income tax due. But remember, the actual amount paid in Canada is 200,000. This is the amount that the corporation has actually paid to the government of Canada, the 200,000. But in our computation, it is said that the limit is only 120,000 pesos. It is called limit because the amount deductible should not exceed this limit. Therefore, if the actual amount paid in the government of Canada is 200,000 and the limit is only 120,000 pesos, we can only claim 120,000 pesos, the lower amount. Again, the amount deductible could not exceed the limit of 120,000 pesos. Okay? So always remember this. When you're going to compute for the limit for tax credit, always compare the actual amount paid and the actual limit. So in this case, the lower amount is 120. On the other hand, we have here the computation of the proportion of the income tax due to New Zealand. So, as we have discussed earlier, the net taxable income from New Zealand is 600,000 divided by the 2 million total net taxable income times 600,000 income tax due. So, the limit for New Zealand is 180,000 pesos. And as we know, the income tax actually paid was 150,000 pesos. Since the actual amount paid is lower than the limit, therefore, it is okay to claim the actual amount paid as deduction for our taxes. So in this case, the 150 is lower than the limit. So we will consider this amount, 150. Okay? So when you are comparing the actual amount of tax paid and the limit, always choose the lower amount. And then after that, we will combine this together, the 120 and the 150. Therefore, the total limit under limit 1 is 270,000 pesos. This is the first step. This is the per country basis limit for tax credit. That is the first step. The second step is to add these together, the 400 and the 600. So, under limit 2, we have the global basis or the entire or the total outside income basis. So, we have here the all countries. We have from Canada, 400,000, and from New Zealand, we have 600,000 pesos divided by 2 million times 600,000 pesos. Our limit is 300,000 pesos. And we will compare this again to the actual tax paid, which were 200,000 pesos and 150. So this 200,000 pesos and 150,000 pesos are the amount of taxes actually paid in Canada and New Zealand, a total of 350,000 pesos. We will compare again which is lower. And as we know, the actual amount tax paid is higher than the limit. Therefore, we will consider the limit of 300,000 pesos. So let us now summarize the two limits. For the first limit, our tax credit is 270. For the second limit, we have 300 and the actual tax paid was 350. So we will choose whichever is the lowest tax credit. So we will have 270 computed under limit 1. Therefore, we will deduct this 270,000 from the income tax due. So remember that our income tax due as computed, when we multiply the net taxable income by 30%, we got 600,000 pesos. We will deduct the tax credit of 270 from the 600,000 pesos. We will have a tax due and payable of 330,000 pesos. The tax due means that this is the amount that should have been paid by the taxpayer. But because of the tax credit, it is reduced to 330. This 330,000 is now our tax due and payable. This will be the final amount to be remitted and paid to the BR. So let us summarize. Let's have these alternatives. Resident, citizens, and domestic corporations may choose any of the two below when it comes to taxes paid in foreign countries. First, claim the taxes paid in its entire amount as deduction, or claim the taxes paid as tax credit, subject to limits. So it is their choice whether they would claim these taxes paid abroad as deductions under taxes category or claim those taxes paid abroad as tax credit, subject to the limit. If the taxpayer claims the taxes paid in foreign country as deduction, it will be deducted from the gross income under the taxes item. Okay? However, on the other hand, if the taxpayer claims the taxes paid abroad as tax credit subject to limits, it will be treated as charged against the income tax due as what we have shown in our previous illustration. The tax credits shall be allowed only if the taxpayer establishes to the satisfaction of the commissioner of the following. So, before any taxpayer, whether resident or domestic corporation, can claim for tax credit, he must first satisfy the Commissioner of Internal Revenue by reporting the following. Okay? So first, the total amount of income derived from sources without or outside the Philippines. So if you are a resident citizen or a domestic corporation and you have incomes earned abroad and you paid income taxes abroad, then before you can claim for tax credit, you must first inform the Commissioner of Internal Revenue that you have earned this amount from abroad. And also, the amount of income derived from each country, you must specify how much is earned from this particular country. Also, you should notify the Commissioner of the tax paid or incurred to which is claimed as tax credit. Such amount is to be determined under the rules and regulations prescribed by the Secretary of Finance. And finally, all other information necessary for the verification and computation of such tax credits. So, again, before you can claim for tax credit, you must first inform the commissioner. So that's it. I hope you learned a lot from this video. And I also hope that you would watch the other videos we have about the other itemized deduction. So if you like this video, give me a thumbs up, hit subscribe, and click that notification bell. So, if you like this video, give me a thumbs up, and if you're new to this channel, hit subscribe and click that notification bell so you would be notified whenever I upload new videos. And thank you so much for watching.